All right, well, welcome everybody to another Blackboard Collaborate session. I hope your classes are going well. Um, we'll begin with a couple of announcements. Homework number 11 is due on Wednesday the 15th, and I mentioned that in our previous class meeting and suggested you get an early start. It's got a couple of problems related to this price-demand relationship type stuff that we did in class last time when we looked at this diagram and we're calculating the optimal demand, maximum revenue, break-even points, and so on. So homework number 10 has a couple of questions related to that. It also just has some kind of general word problems where it's using cash flow and time value of money concepts, but it's not specifically related to any of the in-class exercises that we've done. So that's due on Wednesday, and then Friday, so 1 week from now, is when your final project report is due. Let's take a couple of minutes to look through a spreadsheet example just to refresh your memory on the formatting of that and set the stage for any questions you might have. I'll again encourage you to go ahead and break in with your questions using the microphone. That's usually the easiest way and the most efficient way for you to explain what you'd like to hear some more information on. Or if you prefer, you can send me an email after class and we can set up an appointment if needed. But let's look at a spreadsheet that just illustrates some of the information that you need to include on the project. So you'll notice that this example illustration would be for someone who's relatively young, going to graduate in 2021, and so we're starting off with some assumption about what they're going to make during their first year in the workforce, and of course in the project report it would explain more of the background information about what is the rate of pay that's assumed, what is the employer and the job the student wants to have. And then of course in the project report there would be a detailed explanation about all the expenses that are included in this column, including things like taxes, insurance, housing, transportation, utilities, food, and kind of a detailed data source explanation for each of those. The extraordinary expenses are those sorts of things that only come around occasionally, like a big wedding expense or the down payment on a house, or an extraordinary hospital expenses having to do with a kid being born or sending a child to school, that sort of thing. So then the amount you can save in any year is the difference between the income and the expenses. So if this person had $19,000 worth of expenses during the first year and $43,000 worth of income, then the potential savings is the difference between the two. So in this first year the person is saving $23,550. Now assuming that they don't have any savings to begin with, then they're not going to make any yield. If their saving balance is zero the first year, then they won't make any income that first year. And so the only amount in their savings at the end of the year is how much actually went in during that first year. Now, in the second year, things begin to change a little bit because we assume that this person is going to experience an annual wage increase of 2%. And that's in addition to any raises or other kinds of promotion type salary increases. Now, in the first year, their $50,000 pay is more about that they got a raise. After a single year of experience, maybe you're a lot more valuable to the company than you were previously. So we're jumping from 43 to 50, and the background assumption would be explained in the project report. But then in the year after that, you'll notice that the wage is going up by a multiplier of this increase rate. So the 51,000 is higher than 50,000 in the amount of 2% extra. And then the year after that, it's just the year before it multiplied by 1 plus I, where in this case the increase rate is 2%. Similar thing has been done with expenses. So the expenses in the second year are 3% higher than the expenses in the year before. And why am I using 3%? It's just for illustration. You need to do a little bit of background research and find out what is a good, defensible, representative average inflation rate over the long term. And you can find that data relatively easy, so I don't feel bad asking you to just do a little bit of research on that. But what you'll notice is that the expenses are going up each year, in each successive year, having to do with the inflation rate, but then sometimes the expenses jump suddenly, $21,000 to $32,000, where the annual expenses are going up there, having to do with that person had a wedding and is adding a new household member in this particular year. And so not only do we have this big extraordinary cost of the $25,000 that was spent on the blowout wedding, but now expenses each year are going to be based on a higher cost because there's more people in the household. So after that, it continues going up by 3% until you'll notice that there's another dramatic increase when there's a new dependent that's being born. And so now not only is there the cost associated with the hospital fees and everything that isn't covered by insurance, but now the costs are going up. So that's the idea with how the wages and the inflation is going up each year. And you'll notice that the amount that's saved sometimes goes negative. In the year of the wedding, you're actually drawing down some of your previous savings. So you have a negative amount saved. Luckily for you, that the return on investments was positive. Now, 5.5% is maybe a pretty conservative estimate for what the stock market returns over the long term. And so the amount that is this investment yield is the previous year's savings balance multiplied by the rate of return on investment. So if we look at what is the cumulative savings balance, it's the previous year's balance, so that's the cell above, plus how much you saved in a year, and then also adding in the investment yield. So the investment yield isn't just 5.5% of the savings amount. This is a common mistake that students make all the time. The investment yield is based on your total balance. And so if you look at this cumulative savings balance is going up every year, you earn interest on the total amount that you've got saved. You don't earn interest only on how much you saved this year. You earn the interest amount on how much you had in the bank last year. So the investment yield is 5.5% of last year's balance, and then this year's balance is last year's balance plus how much you saved new plus the investment yield. So this is really critical that you get this right. Any student whose spreadsheet doesn't follow the same approach is really on thin ice and is most likely going to really suffer when it comes to the grades in the end. Let's scroll down a little bit because I got a good question about retirement. How do things change during retirement? So this particular person, let me change the view here so that we can continue to see the column headings. Just a second. All right. So what I'm going to do is I'm going to scroll down, and so you can see that we still have our header titles. All right, so I'm scrolling down. This person is getting older. They're 40 now. All right, there's their kid going to school. Boy, that puts a damper on things. You're having some negative savings for a while. Still, you've got a good balance. All right, now at age 60, this person decides to retire early. Most people don't retire as early as that, but suddenly the income, which had been growing each year, suddenly goes to zero. And the expenses, if anything, they skyrocket because this person wants to buy a motorhome for $300,000 and then travel and golf a lot more, so their expenses are going up. And so they have no income coming in and big expenses. And so if you look at, they had right before they retired $1.6 million and figured, this is going to last forever. I'm a millionaire. I've got money just that could never run out. But after all those years, it's going down and going down, and even when Social Security kicks in, so we still now finally at age 68 have some income from the government because you've just been living on your balance till now. Now you have some income from the government, but this person assumes that they're going to live until age 75 and they go negative. They actually run out of savings before they get there. So what this project illustrates is it's kind of an iterative process sometimes deciding how much you're going to spend. So you can't go to negative before you die. So maybe you're going to buy a cheaper motorhome. Instead of $300,000, let's buy a $100,000 motorhome and then see, does that last us? Well, we don't go into the negative zone until just before death, and so we just have to cut costs a little. Instead of $150,000 a year, let's say $140,000 a year, and then growing from that. And then we see, all right, this person doesn't run out of money. So then in the end, what we could do is we could do a graph of age versus cumulative savings balance and see how during the working years it's growing and growing and growing, and then the person retired early and it took a dramatic downturn. The income, that's the Social Security that this person is relying on, helps out a little bit. You know, you're not falling quite as hard when you have a little bit of income, but when your income's $48,000 but you spend $172,000, that means the net difference is $124,000. Some of that can be made up because you're still earning a rate of return on your balance, but it's a net decrease. And so the next year after that is lower, because it's looking at the previous year's balance plus you're adding in how much was saved, and it's a negative savings, which means you're spending more than you had income, and then the investment yield helps a little bit, but the net balance keeps decreasing. So then this person, if they died, their heirs would have $66,880. So that's just an illustration on the project. If you have specific questions about this, I encourage you to get in touch, send me an email, or we can have a meeting. But it's really important that you get this right for the project. The project is worth 9% of your course grade, so it's certainly in your best interest to take it seriously, because it can have a significant effect on the weighted course average at the end. Okay, we're going to talk about break-even analysis today. And last time I used the word break-even in a different way than it's going to be used today. In our class meeting on Wednesday, break-even was talking about the number of units that should be sold in order to ensure that your revenue is greater than your costs. And so, D prime 1 and D prime 2 were your break-even points, and so it was more about the volume and demand. There's other ways to use that same word, break-even, though. And so before we get into that, let's just look a little bit more at the differentiation between costs that are fixed and costs that are variable, because that was one of the things in this previous figure. The fixed cost was the horizontal line that we see. The variable cost was the difference between the fixed cost and the total cost. And so your variable costs are affected by the level of productivity that you have, how many units are being sold and made. So in the case of what if you operated a factory that makes Twinkies? So think about what would be your fixed costs and what would be your variable costs in an operation like this. So the definition of fixed costs is the expenses that don't directly change as a function of the level of productivity. So if you're making 100 Twinkies per day or 10,000 Twinkies per day, your fixed costs don't change. And so some of the costs that are unrelated to how busy you are on the factory floor would be the rent that you pay for the real estate that your factory occupies, or maybe the liability insurance, or the salaried employees. And so management typically is being paid on an annual basis, and that's not directly tied to, for instance, the number of shifts that you're operating per day. So there's a variety of things where the cost doesn't change based on how many items you're making, but the variable costs do. Variable costs in the case of a Twinkie factory maybe would be the plastic that the Twinkies are wrapped in, and the sugar and hydrogenated oils that go into the food. Well, food, maybe not the right word for it, but the material costs, the cost of the hourly labor. And so you can see that there are some costs that are going to be affected by how many items per day is being produced. And so that's just to further clarify the differentiation between fixed costs and those that are variable. So here is an expression that's showing if we have a linear relationship, meaning that no matter how many we sell, each additional unit is costing the same to produce. And the reason I show you this is to contrast it with a nonlinear relationship. So look at what's happening here. that curve is tapering, and so the variable costs are getting less significant as the unit cost, as the number of units produced goes up. So that curve is flattening out. So that means that at first, when you were making the things, you had to spend a certain number of dollars for each item that you're producing. But the more you sell, that curve getting flatter means that your costs are decreasing. Your variable costs are decreasing. And some of the things that could cause that is if you're getting a bulk discount on the items that you're purchasing, the raw materials. And so just one example would be if you are buying sugar. Buying sugar in a 5-pound bag, you're probably going to get a different price than if you buy sugar by the rail car. If you buy a rail car full of sugar, probably the cost per pound will be significantly less. And so a nonlinear cost relationship could occur when you're getting a bulk discount for buying a lot of things. And so this is the break-even point, just zoomed in. Last class we were looking at the point at which the revenue is greater than the costs. And so revenue is the number of units sold multiplied by the sales price. And at this point of intersection between the costs and the revenue is where the two are equal. And so to the left of that means that you're operating at a loss, and to the right of that means that you have profit. Now, if your variable costs go down, let's say for instance that maybe you've noticed gasoline is a lot less expensive than it used to be. So if suddenly some of your cost inputs decrease, then that shifts the break-even point to the left. And just to point it out here on the figure, this was our original break-even point. And let's say that our production costs decrease. And when the production costs decrease, the new point of intersection between the revenue line and the new cost curve is further to the left. So that means when your costs go down, you don't have to operate you don't have to make as many in order to have the break-even point. So you can be profitable at an earlier production point. So that's what happens when the variable costs are reduced. The break-even point moves to the left. Okay, now this is the heart of what we're going to be working through in today's in-class exercise. Let's say, for instance, that we have two options for a piece of equipment. Or it could be a piece of equipment or a way of making something. One option has a higher fixed cost, and so the intersection with this cost vertical axis, that represents the fixed costs, and then how steep the slope of the line represents the variable. So this alternative 2 it has a higher intersection point. So that means it has high fixed cost, but the line is flatter, which means its variable costs are lower. So it costs a lot up front, but then for whatever reason, it doesn't cost as much to operate compared to alternative 1, where alternative 1 is cheaper to purchase up front, but then the cost per unit in operating it, because that line is steeper, is a greater cost per unit. So there's a point at which it's better to choose alternative 1 versus alternative 2. And what this illustration is showing is that if you're not going to make very many items, like if you have a relatively small operation, then you should buy the equipment that's cheaper up front. Because even though it's not as efficient on a per unit basis, you're going to be better off, you're going to have lower costs when you are to the left of this break-even point between alternatives. When you're to the right of the break-even point, that means you're making a lot of units. And so even though equipment 2 costs more up front, the fact that each unit can be made more cheaply means that your total costs are lower with alternative 2 when you're to the right of this break-even point between alternatives. So this is the concept between the in-class exercise that we're going to be working on today. And I sent out an Excel start file as well as the InClass exercise. I sent that out by email maybe around about an hour ago. So hopefully everybody's received that file, because we're going to do an illustration that goes through the analysis procedure to identify which alternative should be selected based on a certain level of production. Any questions before we get into that in-class exercise? So here, break even means the point at which each of the two options have the same cost of production. And so which equipment to buy depends on whether you are to the left or to the right of the break-even point. All right, now here's a summary of the in-class exercise that I sent you by email. Let's go through it together before we start crunching the numbers and open up the spreadsheet file. It says that a company which has a MAR of 9% is going to buy some new equipment they use in production, and they have two alternatives. Option 1 is computer-controlled equipment, and option 2 is manually controlled. So of these two options, you can see that option 1 is more expensive up front. It's a $2 million piece of equipment compared to option 2 only costs $1.3 million up front. So option 2 is cheaper, but it has some negatives. If you look, it doesn't last as long. It only lasts 7 years, compared to option 1 will have a life of 10 years. And option 1 is also better in the standpoint that it has a salvage value, whereas option 2 doesn't have any salvage value. After the 7 years, we're just going to throw this piece of equipment into the Ohio River and go buy another one. So it has no durable value. The labor costs are also cheaper on option 1. I think part of the reason why we like option 1 is that it's computer controlled, and so it doesn't require as many people to be involved with the manufacturing process. The computer is doing some of the work, and it produces the items more quickly. If you look at the output, in an hour, option 1 can make 3 of whatever we're making, whereas option 2 can only make 2.4. So the computer that's controlling things, in the case of this more expensive option 1, it's able to kind of knock out the items more quickly, and so that's going to give us some savings in the labor costs, because if you don't have as many hours of operation, then you don't have to have the people, you don't have to pay for their salary as much. And you'll see that when we go through the in-class exercise. So what we're going to do is we're going to compare these two things. In step A, we'll calculate the capital recovery. Part B, we're going to look at the cost of each alternative if we're only making 1,000 units per year. So we'd want to know, should we choose option A or option 1, or should we choose option 2 in the case of 1,000 units per year? And then we'll switch things around and we'll look at what if we made 3,000, and then we'll look for the break-even point. Okay, so if you have that template file that I sent out, which looks like this, please open it now. What I'm going to do is I'm actually going to just pause for a moment, and I'd like you to start by putting in the interest rate. The interest rate that the problem statement says is 9%, so 0.09. And question A asks you to find the capital recovery. So find the capital recovery for both options. And you know what that is because you've seen it on the exam. So put in the first cost, put in the lifespan and the salvage value, and then use this information that you filled in order to calculate the capital recovery. So on an annual basis, how much are we spending to own and operate this equipment? Alright, so I'm going to stop talking for a moment and give you some time to calculate the capital recovery, and then I'll rejoin and demonstrate that, and we'll continue moving forward. Alright, so capital recovery, let's see, put in our first cost. What was that? 2 million versus 1.3 million. So 2 million versus 1.3 million. The computer controlled lasts for 10 years. The manually controlled lasts for 7. Alright, the salvage value, 150 versus 0. So 150,000 versus no salvage value. And then to calculate the capital recovery, we're going to do the payment function. So equals minus PMT. The rate that goes in is the 9%. I'm going to anchor that reference so then I can just drag sideways when I'm doing option 2. So the number of years is 10 in the case of option 1. The present value is the first cost. And then the future value is the salvage. So it's going to annualize the difference between the first cost and the salvage value. And that negative sign that I put in is because Excel is always changing the signs and I want to keep it as minus to represent a cost. So the capital recovery for option 1 is 301,000. If I drag that sideways, it'll apply the same function up here to the options that we have for item number 2. So option 1 costs more to own and operate on an annual basis than option 2 does. So it's more expensive equipment just on the equipment side of things. But we're also going to be looking at the labor costs. And so here in part B, so we could fill in option 1 and option 2 capital recovery. That's what we just found. Now part B, it's for 1,000 units per year. So let's say if we're operating at 1,000 units per year, what are the labor costs for option 1 versus option 2? Okay, so labor costs is 180 versus 195. So 180, I need to put in a minus sign because costs are negative. 185 versus 190 is 180, 195. Screwing it up. 180, 195. Alright, and then the productivity, we can make 3 units per hour with option 1 versus only 2.4 units per hour. Alright, this is a spot where students would generally make, not everybody, but frequent mistakes. This row is asking how many hours are needed to make the expected output. Alright, so we need to make 1,000 of these. If you can make 3 per hour, how many hours does it take? So it is 1,000 units divided by 3 units per hour. It's going to take 333.3 hours. Whereas this one is going to take more time because it has a lower productivity. So you can only make 2.4 in an hour, which means it takes you 416.7 hours to do that. So now the variable costs take this labor differential into account. So we have to pay $180 per hour, and we're using 333.3 hours to make 1,000 units. So now we've got our equipment costs of 301,000 and our labor costs of 60,000. So do that same thing for option 2 and find out what would be your variable costs for option 2. They're going to be higher. The total costs are the combination of the two. So it is our fixed and variable. So the question is, of the two, which is the option that should be selected? You can see I've already got the conditional formatting applied, so the less negative value, the amount that's higher means it's the lower cost. So is it better to spend $339,000 or $361,000? Assuming all of the things are equal, that the quality of each item being produced is the same, then it's better in this case for us to choose option 2 because it's less expensive. So if we go back to this figure that I showed you earlier, we're looking at, this is an illustration of break-even between alternatives. And so we aren't making very many items, and so it's better to select the alternative that's less expensive up front, even if it has a higher unit cost of operation. And that describes option 2. And by the way, how do we do that conditional formatting? Let me clear what I have there. So clear the existing rule from the entire sheet. Alright, so you highlight these two cells and you go to Home, Conditional Formatting, New Rule. And the new rule that we're going to select is only the top or bottom ranked values, and we want the top one value. So that means it's going to choose of the two that are selected, the value that's highest, meaning least negative. And then the format that I want, I don't know why it always enables strike through, so let's turn off strike through and just make it bold. And so click OK and then OK again, and what it will do is it will in bold select the item that's least negative. Alright, so that's for 1,000 units per year. The next part of the InClass exercise asks, what if you're making 3,000 units per year? So we just looked at, for 1,000 units per year, what was the cost of each alternative and which alternative should we select. And in the case of lower production, it's better for us to buy this manual controlled alternative because its upfront cost is so much lower. But if you're going to make 3,000 units per year, the balance may shift. It may turn out to be that option 1 is less expensive. So let's go back to the spreadsheet and take a look at if instead of 1,000 units per year, what if we're making 3,000 units per year? So just type in 3,000. Everything should update automatically. Once we type enter, you'll notice that the capital recovery costs didn't change because those are just based on the purchase price, the salvage value, and the number of years. And so we didn't change any of that, but our labor costs did vary. Now we're making 3,000 units per year, so what it changes is the number of hours per year that you have to operate this equipment. And if you're operating it for 1,000 hours, and each hour of operation costs $180, you'll notice our variable costs are only $180,000 for option 1, but option 2 is much more expensive to operate because it requires 1,250 hours of operation to make the same number of units. Because its productivity is lower, it takes more time, and then each hour is more expensive too, presumably because you've got more people on the job. You've got a bigger crew to operate this manually controlled equipment. So the variable cost differential is large enough that it makes option 2 more expensive than option 1 when you're generating 3,000 units per hour. So any questions about this so far? Is there anything that I could illustrate another time, something I maybe went through too quickly, or a formula that you need to see? Don't be shy. I'd be delighted to have someone use a microphone today. That would just make me feel like this was a real interactive class. Not just talking to a laptop in my basement. All right. Let's look at the last part of this in-class exercise because... wrong one. All right, so it says, using goal-seek, what is the expected output that makes the two options equally expensive? So what we're looking for is we want to solve for the break-even point between alternatives. So what is the balancing point at which the two units are equally effective in terms of minimizing cost? So we could just keep changing this manually. 1,000, 1,001, 1,002. Oh, no, I'm doing it in the wrong spot. Okay, 1,001. Yeah, that's not it. 1,002. Now, you know better than we don't really need to do that. We can do a goal seek. What we're looking for is the difference of these to be 0. So this cell, where it says difference, let's do equals one cost minus the other, and it's going to tell us the difference in cost. And our objective when we do the goal seek is find the expected output so that the difference is 0. So again, let me pause for a moment and give you some time to do that goal seek and find if you can find the break-even point between alternatives. Alright, so data, what if analysis, goal seek, and we want this difference to be equal to 0 by changing the number of units that are being generated. Click OK, and that tells us that 2045.62, and you can't make a fraction of a unit, so it would be 2046 units is the break-even point between alternatives. So here, using goal seek, what is the expected output units per, I think that should have said year, units per year, that makes the two options equally expensive. So the expected output would be 2,046 units per year. Alright, and the last question was write a brief summary about which alternative should be purchased under what conditions. So kind of like create your own decision criteria. A statement, an if-then statement that would describe which option to select. And so that might sound something like, if your expected output is less than 2,046 units per year, then option 2 is less expensive. However, if your expected output is greater than 2,046 units per year, then option 1 is preferred. So let's see if that's true. 2,047. Okay, option 1 is a little bit cheaper, but if it's 2,045, then option 2 is a little bit cheaper. So that verbal statement that describes under what circumstances one option is better than the other. Alright, so that is break-even between alternatives. So let's take a look at the homework assignment that you've got due. Just briefly to put that on your radar. Okay, here it is. So question 1 is a price demand type problem similar to what we looked at in the last class meeting on Wednesday, and so is question 2. It is a price demand relationship problem. And then questions 3 and 4 they're just kind of I guess word problems where you're using your algebra skills and your knowledge of the time value of money to figure out how many, for example, how many hours a month an airplane needs to be flown, or when two forklifts can be compared. So there are 6 questions in that assignment, and then question 6 is a throwback to previous cases where we've done in unrecovered investment balance problems. And so I think you've done that sort of thing previously in class 18 and in homework 7. So that idea of an unrecovered investment balance, we're going to reinforce that idea with question 6. So if we just take one last look at the announcements for today before we part ways and you enjoy your weekend. That homework 11 is due on Wednesday, and then the project is due a week from today. So we're in the final countdown now. If you have project questions or questions on the homework, feel free to send me an email, and I'd be glad to help you out. So that's all I have for you today. Hope that you're doing well, and I'll see you on Monday. Bye-bye.